Greetings and welcome to another edition of the Ad Astra Kansas Money Talks podcast. I'm Joe Blubon. I'm joined, as always, by Bob Schwartz and Mark Johnson of Bob Schwartz Financial. You can find out more about them at bobschwartzfinancial.com. They have offices in Victoria, Kansas, as well as Silver Lake, Kansas. And of course, if you're watching us on YouTube, we would love it if you could subscribe and hit that thumbs up. Give us a rating on your favorite podcast distributor of choice. And with that, as we've said on this before, sometimes we talk about issues that impact Kansans more directly. Sometimes we just talk about money issues. And today's one of those. As we record this, we're seeing a lot of volatility in the market, a lot of ups and downs on a daily basis. We've got Trump 2.0 going on. We've got the threat of tariffs. We've got tariffs that have been put in place. We've got tariffs that have been pulled back, and the market is a little concerned these last few days about that. So we thought maybe we would take a little bit of time and talk about market volatility and what's the best way to navigate through that. So with that, I will turn it over to you gentlemen and maybe talk a little bit about what do we mean when we talk about volatility and maybe a little bit of the history of market crashes.
Yeah, I'd say the first thing, with market volatility, we see these ups and downs, these days where, you can't really necessarily make sense. There's not really much like, hey, there wasn't a huge thing that happened that should have caused this downturn or uptick. Maybe it's just noise in the media, noise somewhere, things that we can't control, but they're up and down. Not as much concerned with like the fundamentals of actual companies. More of, scared buyers or scared sellers. But one thing that it remains very true, and when I look the Morningstar article that we're kind of basing this off of, and I love this, if you invested $1 in 1871, $1 into the stock market in 1871, just like, let's say if it was just in the, just in the broad stock market index, it would be over $31,000 today. That's riding every single wave in American history that we've had go through our country: World War I, World War II, Vietnam, the dot-com bubble, the housing crisis, or the housing...
The Great Depression.
Yeah, the Great Depression.
Tariff Acts of 1887.
Yeah, every single one. Your dollar is $31,000 now. No one's alive now from that, but...
Yeah. But, that you kind of describe volatilities, the ups and downs, and, the kind of the departure from the mean, so to speak. And I don't want to foreshadow what we're going to get into a little bit later, but you said something that immediately said to me, sometimes it doesn't make sense what the market does, which means it becomes very hard or maybe even impossible to time the market. And I bet we talk about that a little bit today as well. So with that, you kind of mentioned a little bit about the history of market crashes. Probably the I don't know this, I'm guessing, but probably the largest market crash or largest over time down market was probably the Great Depression. Would you say that's the truth, Bob?
Certainly, yes. 1870, 1887, they had huge market corrections. The difference back then was nobody was in the market. In 1929, nobody was in the market. It was that was a 2 years into the Great Depression. America didn't realize they were in a Great Depression. I mean, otherwise, hindsight's always 20/20. But the thing about risk, it's all about risk there, and we don't see what risk is. 9/11, that the market took a huge drop then. COVID, nobody sat at their advisor's table or nobody sat at their kitchen table and said, we've got to prepare for an epidemic. To come through, or we've got to prepare for what happens if somebody, has a terrorist attack on us, or if all the banks go broke. 1929. What's that going to look like? Because nobody's prepared for that, and that's why your portfolio kind of has to be balanced in the sense of how much money do I need a year from now, 2 years from now, 3 years from now, and then how much of my money can I have long term. I hope I didn't jump the ship there.
No, not at all. So you didn't see many clients during the Great Depression? Is that what you're saying?
No, I was a client at that time.
I gotcha.
Yeah. Grass wasn't green then, Joe. It was brown. Yeah.
I kid, of course.
Yeah.
More recently, and the one that I'm sure more people can relate to would be the lost decade. From 2000 to 2013. I was still a kid, but I didn't kind of realize how much of how long of a recovery it was from the dot-com crash. Things start to get kind of better. Housing crisis, or the housing market collapses.
And that was in 2008.
Yeah, in 2008, and
credit swaps.
And all of a sudden it takes till 2013 to really get out of it. That's a long time. And we talk about they use the fear index, and they're like the pain, and the pain index of like how hard, like that was one of the worst times in American history for being like holding on to your investments and being scared.
And a little personal story, if you don't mind. In 2001, 2002 timeframe, I actually worked for a .com, and one of the things where people really made money when you were working in that industry was through stock options. And I got my first set of stock options granted to me, and I thought, here it is. I'm finally, I didn't have two nickels to rub together at that point in my life. This is my first job really out of college, and I got those first stock options and thought, here we go. And within days, boom, the market was out underneath it. I couldn't even exercise those stock options because the price dropped so bad. And just like you said, basically from 2000 to 2013, there were a lot of ups and downs in there, but the market was flat pretty much all the way through.
Actually, the way people made money during that period, that long sideways movement of the S&P 500, was the dividends. The market moved sideways, but the dividends increased during that period. And that's why Mark and I feel how important that is in a person's portfolio, to have those dividends generating some return besides the market, because the market can go sideways.
Yeah, absolutely. Yeah. Other ones that you kind of mentioned on here, we talked about COVID-19.
Yep.
And I remember within a couple of days of when it became kind of clear what we were dealing with, the market, it was like, wow. Now, granted, that one didn't last very long, but...
Shortest one in history.
Yep.
Yeah.
8% in one day.
Yeah, it was a big crash. Quick recovery, though, thank goodness. But once again, we're going to talk a little bit about this and how we navigate these markets. But if you were getting ready to retire at that point, that might have been like, holy cow. And there were a lot of people, because of COVID-19, decided to retire.
Sure.
So that timing there could have been a double whammy, and for sure.
I think COVID at least shows you about how our country's, gotten better at, handling these downturns. Our economic situation, our the Fed, everyone, we've gotten better at figuring these things out,
Yeah, and there's a price to pay for everything. And so during COVID, what did the government do? They pressed down interest rates to get money back into the economy, and they printed money. Mm-hmm. And all of that helped turn that thing around fast. What was the price we paid for that? It's called inflation.
Yeah, of course.
And of course then the Fed raises interest rates, and it's it's constant. But these economists, you might as well go out and listen. We might as well talk about what the weather's going to be in a month.
Yeah.
Because we're going to do just as well as the economist, and that's where we at our practice pull back to the what do we have control of? We have control of understanding how much money you're going to need out of your account in the next X number of years, and we better provide where we can guarantee you that that's going to be there. And then talk about risk and reward and things like that.
The one era that people have talked about how they compare it with right now is the inflation around Vietnam, Watergate, little political turmoil scandal, combined with conflict. Like today maybe that's Ukraine,
right.
And a high inflationary environment. And So it was interesting. I was reading about how, like, they're trying to make a mirror of what, today versus what's a time period. And I don't know, you
Yep.
lived through that time
Yep,
period.
I was there.
Yeah. It's like-
Yeah, whipping. We had buttons that said "Win." Whip inflation now. Yeah.
In fact, when we had our was it 2022? Was that or 2021 was our
2022 was the
almost 9%?
Yeah, market
inflation?
drop.
Right.
Yeah.
But I think that was the highest since like 1982, wasn't it?
Yeah.
The highest rate of inflation. So
Yeah.
it kind of goes back to that. And of course, in 82 was towards the tail end of that era you were just talking about. But I remember, I'm in real estate and I've talked to folks about buying houses in that time frame. And can you imagine? We talk about 7% being a high mortgage rate now. They were paying 14%. That's how bad inflation was and how they were trying to fight it with mortgage rates back then. Or interest rates.
I find it very interesting what boomers went through, and I'm a boomer. I'm right in the middle of them. And when I can remember my mom calling up, going, "We got 14% on a CD," and going, "Hey, Mom, that's great. I just bought a house and I'm paying 13% interest." It was amazing then. When we moved to Silver Lake, we got our house. It just ticked under 13%. We were like 12 and 7/8, and we were tickled pink. And I tell that story to my sons, and they're like, "You're an old man. Shut up. That's never going to happen again." Then all of a sudden they're going, "Yeah, interest rates are at 7%."
Yeah.
But as the Fed, hopefully, as time has gone by, it gets better at things. They get better at, okay, this is probably going to happen next. We need to do this or that. But that was a very, very interesting time. And then when all of our children were getting out of school and getting out of college, what happened to mortgage rates? Our kids were borrowing money at 2%. And us boomers were getting what on CDs?
Right.
1%.
1%.
It's kind of amazing how the largest population, and this wasn't done on purpose, but how that largest part of our population at that time helped take care of our parents in retirement, not through any money we handed to them, but through the CD rates they got because of high CD rates.
Right.
Our children got to buy houses at reasonable interest rates at the expense of who?
The boomers.
The boomers. And I find that interesting that they were the largest part of our population. So we take all credit for anything good that happened.
So let me ask you this, Bob. What you just said got me thinking. Do you think that maybe that set of facts, the fact that interest rates were so high at one point and so low at another, that maybe that drove your generation to really get involved more in the stock market? And maybe that's kind of built to where we have today, where more and more people are involved?
The 15% of American population were in the market in 1970. Today it's 70%, and should be more. Because A, there's more information out there. B, it's not so expensive to enter the market. Back when I started in this industry 48 years ago, it basically cost 8% each side of your trade. And that was what brokers charged, and at least 5. And then, of course, the Charles Schwabs came out, and it's become more efficient. But also, you two can read so much more than was available to me as an advisor 48 years ago. You can read more in 10 minutes than I could pull out in a month.
Right.
So,
which makes sense.
And then the 401ks aimed us that direction, and there are great opportunities for the American people not having a pension but having a 401k. There's great opportunities, as you both know, to build wealth, and we're seeing more wealth today than we want to talk about how bad a shape the country's in. And if I say this to people my age, how much more money do you have than your parents had? They'll sit there and go, "Yeah, you're right.
Yeah,
you're right."
Yeah.
And that's, of course, what I expect for my sons, as they, when they're my age, to go, "God, we got so much more than Dad and Mom had," because I think that's America. And but as we age, as America ages, and we understand equities better and the value of that, of being there, there'll be more positioning in that direction.
And you mentioned more and more people are in the market, which brings us back to our topic today of volatility. Yeah. There is it's important for people that are in the market to understand that it's not every day you wake up and you're a little bit richer or you have a little bit more wealth because the market went up. There are ups and downs, and sometimes there's big downs. Yep. We talked about COVID only, it recovered within a month, didn't it?
4 months.
Yeah,
4 months?
4 months.
Okay. And then you talked about the lost decade where 13 years it took to recover. So how would you say that you would measure the severity of a market crash, so to speak?
Yeah, there's this thing called the pain index.
Oh, that's a great term for it.
And so pretty much it's called depth plus duration of the decline. And so for example, the Cuban Missile Crisis was a drop, of 22.8% versus the Great Depression at 79 or minus 79. Those are pretty two different things. Where you see, the Cuban Missile Crisis had less pain because it was a shorter time frame than the Great Depression, where multiple years and a larger downturn.
Yeah. So you're looking at it from two different angles. How big was the crash, and how long did it take to fully recover? That makes sense.
Yeah. So the biggest ones in history, there's only one that has 100% pain index, and that is the 1929 crash and the Great Depression. And then the other top times for pain in American history are the lost decade is 2 that we talked about, and then inflation in Vietnam and Watergate is 3. After that, we see World War I, Great Depression, the post-war bear market. Those are our worst times for this pain index in our history.
That's interesting. I never knew that there was a term for that.
Yeah.
And the least painful was
COVID?
Yeah, was in American history our least painful downturn was COVID because of that, the time aspect of that.
And I think another great point there is Mark and I are getting calls now about about tariffs and politically what's going on. And, in my lifetime of voting, I don't know how many presidents I voted for, but quite a few. And probably half of the time, the person I voted for won, and probably half the time they didn't. That did not affect my stock market investments one bit. And I would say to people, if you're going to let personal beliefs or politics get in the way of your investment portfolio, long term, it's going to hurt you. I said that 4 years ago to clients, and I said it 8 years ago, and 12 years ago, and 16 years ago, and 20. It's a cycle. When a new party comes in control, there is some consternation. The American stock market has gone through 47 presidents, and it's performed very, very well over its history. And
yeah, we've talked about we've talked about every one of these time periods. Well, at the end of them, what happens?
Wonderful recovery.
Yeah, we've recovered every single one. The market goes up.
And honestly, you kind of need some of these dips in there from time to time. Now, obviously, if you're getting ready to retire or you're needing that money for some reason, a crash can be really, really serious to you.
Getting ready to retire.
Right.
Yeah.
Absolutely. But if it's somewhere where you are maybe, several years from retirement, I kind of look at it like, hey, stocks just went on sale.
That's right. TVs are free. Yeah,
absolutely.
I think a great point on that is that as we look at volatility and talk about how much the market can move, it's not dependent on anything but how are those companies doing and how are they performing and how much are they making in terms of being able to give back some of their income to their investors and being able to build through research and development and expand. So consequently, I think when we talk with clients about volatility, they have to understand that this happens and the price that we pay is that.
Yeah.
That volatility.
It brings to mind to me that for somebody who is coming up on those retirement years or for whatever reason is going to need to access that money, a downturn like this can be, obviously concerning, but I would also argue that if you've positioned yourself right, you should be probably taking less risk by that time, and that's where it's so important to have a game plan, not just when you get to retirement, but when those years leading up to retirement, and that's where folks, like yourselves can help people out. So that way, when you do have this downturn in the market right now, it shouldn't be something that's big and scary to you because you planned for this.
Yeah, I think that the longer recovery takes, the more it has an effect on people's psyche. But also there's so much psychological issues that go into retirement that you need to make sure that you're aware of when you go in. Like, have you ever pulled money out of your account before?
Yeah, have you been a net saver all your life?
Are you ready to spend in retirement? Like, there's a lot of things that you should be taking stock of as you're approaching that time. You're, not just what everyone thinks is, the portfolio. Okay, how do I positioning myself? But there's a lot of things that, like, just talking through with an advisor or your spouse or your kids that need to happen there. And so, market downturns are just, there's something that they're going to happen. But make sure, like you just talked about, that we are positioning yourself, and that not just positioning yourself in the market, but also who you're talking to, making a plan, getting yourself psychologically ready. Yeah,
absolutely. You said something very early in this podcast about, sometimes the market does things that just doesn't make sense, and you couldn't have seen it coming. And I kind of hinted that we're going to talk about this, but that makes one of the biggest personal things that I have done. I've done it twice, and I swear I'll never do it again. Is I've tried to time the market both times. I don't even want to think about how much it cost me. Both times it did not turn out like I thought it would. I was just certain that I knew what I was doing. Timing the market's impossible, is it? Wouldn't you say that?
When somebody wants to time the market with us, which we don't have that happen anymore because we prepare our clients, I think, a much better, we're better now than 20, 30 years ago. But when somebody would say, let's get out and I'll get back in, my comment to them always has been, you tell me when to get back in, because I don't know when it bottoms. And, inevitably they get back in when it's already back where it was, hey, I got out. Hey, I shouldn't have got out. If I'd have ever done that, I would say the same thing because it's a fear thing. It's a fight or fear. And if you pull money out of the market, you've had fear and you don't want to fight again. So you're never going to go, yeah, okay, get me back in. Because if it keeps dropping, you're going to say, yeah, I was right.
So we got that. That's clear. Your guys' recommendation is don't try to time the market. So do you just suggest that either people completely go into, if the risk is too much for them, go into something that fits their risk tolerance better, or do you recommend staying invested? Maybe both, just depending on the individual person?
I would 100% say, every person is different. Everyone's portfolio should be different. Everyone's their own person, their own portfolio. If you have less risk tolerance, then you should be in some fixed income. Maybe a majority of your portfolio should be fixed income. We're going to try to probably talk to that person about taking a little bit of risk to be, to fight inflation with, but ultimately it comes down to that person, what they can handle. And so, like, in these stock, the greatest investor of all time, what's he going to tell you? Warren Buffett's going to say, stay engaged in the market, and that's what we would recommend people to do too.
Don't break the cycle of dividends, and it's our job as fiduciaries to make sure our clients are invested at their risk tolerance. Do we have clients that are 100% in fixed? Yes, we do, because they have no risk tolerance, and we respect that. But our clients that are in the market with us, the other, and I've done this for a long, long time, so I'm a grouchy old man. But if our clients ever told us to get out of the market, they're not getting back in, not with us as their advisors, because I will just tell them up front, I evidently did a poor job of understanding your risk tolerance. Never have had that happen, but I have told people that if we get out, we're not getting back in. You're going to have to go somewhere else because that's not. We want to do what's best for you, not what fear is making you feel.
That makes a lot of sense, actually. So you kind of mentioned it, but really it sounds like it comes down to obviously the individual situation, but you need to make sure that the risk management and the diversification for that individual is kind of forefront and center, is what it sounds like.
Yeah, every single person has their own needs, has their own risk, and our job is to help them go through that journey. And sometimes maybe that is convince them like, hey, maybe we need to take a little more risk, or maybe you need to be a little safer. That's our job. So.
Yeah.
Right. That's what we bring to the table. That and our ability to help educate our clients so that when we have market corrections, our phones aren't ringing off the wall. Do we get a phone call or two? Yes. Every cycle we get a call. But once we say, well, are we going to need, besides a car in the next 2 years and your monthly income, are we going to need anything else? No. Okay, we've got that already in treasury bills. The rest of your money we're going to continue to let work. And I think that helps give our clients some security in the sense of they know, hey, hopefully these guys know what they're doing.
Yeah. And you kind of brought it up. For your clients that you work with, you've got them positioned in a way that takes care of and kind of addresses the volatility. So down market for a year, yeah, not great, but you've got other things in place that they can live on, keep that same quality of life that they're used to, be patient with the money that's in the market, because one thing that I don't know that we've mentioned, but it's true of every one of these downturns that you've talked about, every one of them has had a recovery. Some have taken longer than others, but in 100% of the situations, the market has recovered.
Yeah. It might hurt to go look at your app on your phone every day, and it might not go, right back up to where it was 3 weeks ago. But over time, maybe just shut that thing off for a month or two. Maybe don't look at it for a little bit, and that's going to help you a lot more. And I've realized that too for myself. Sometimes just not looking at that stuff and letting the market do its work is what's best.
Mr. Buffett talks about the stock market is the only place where inaction probably beats action in most cases. Otherwise patience, time. You guys got me thinking back to I got out of college in 73. I opened up my first mutual fund account for $250 that summer. That was a lot of money. I wish I still had that account because I'd like to know what it was worth today. But basically since that time, anything I bought, I still own today in equities. And, has it gone down? Yeah, I've watched it go down. But it has rewarded us as a family so much because of the 48, actually I've done it for over 50 years because my brothers who got me into the market. The value of time and money is unbelievable. And people can build, and I know all three of us off this show have talked about this, can build generational wealth for families and not have to have an income that, is a CEO's income. Just having, hardworking Kansas income. And I find that very amazing because most people listening are that we target, ag producers, they see one way for that, right? And what's that? More land, And like we like to point out to people, there's another story out there that's called equity that you don't have to go out and plant. It takes care of putting the seed in and returning it to us. So
as we kind of wrap this episode up, Mark, Mark always does a great job of kind of giving us some notes, and there's a key takeaway that you put down here, and I just love it. So I'm going to read it. I'm going to give you the credit for it because you're the one that put this together. Your key takeaway from this whole episode is the biggest risk isn't the market crashing, it's making the wrong decision at the wrong time. And I love that because it really sums up what we're talking about here. Crashes are going to happen. Corrections are going to happen. Downturns in the market, they happen on an almost weekly or monthly basis. You're going to have some little correction here or there. It's the decisions you make based on those stock market conditions that can really cause the problems.
Yeah, exactly.
Lean into a down market. Yeah, if you have the capacity to lean into it because it's an opportunity. Yep.
Great point. Great point. Well, gentlemen, thanks again for another great episode. Lots of great information here. Once again, give us a thumbs up, subscribe, follow us on your favorite podcast provider. We appreciate that. And these guys are great. If you ever decide that you would like some help as you navigate through either planning for retirement, those years leading into retirement, or just doing some general investing, these two are the best. So bobschwartzfinancial.com. You can look them up there, get all their contact information, and I'm sure they would love to help. So with that, thanks for joining us, and we hope you have a great day.
See you next week.